Apple shares briefly were at least 20% below their highs on Friday. The stock was off 12% last week alone, leading big tech names down. That does not necessarily mean all is lost. Could be a bad omen, could be an opportunity. Joining us to talk about that and what may work for your portfolio, Dan Morgan, Senior Vice President and Portfolio Manager at Synovus Trust, and Gene Munster, founder and Managing Partner at Loup Ventures. Guys, good morning. So, Gene, obviously there's the part of this where you want to tease out what the direct effects might be on an Apple, but also just trying to handicap, how far the stock went in a short period of time, and perhaps just an unwind of a somewhat crowded position. So, where do you come down?
Mike, I don't feel like this is a crowded position. I understand that it performed well in 2019, but ultimately, if you step back and think about everything that's going on, the world will eventually, hard to predict when that's going to happen, but eventually return to what will be undeniable truths. Some of those truths are 5G, the concept of healthcare, which impacts wearables. You think about services. Apple has kind of the pole position within that. And so my view is this: for the small group of investors that have the luxury of doubling down, I think that Apple is the story to double down here, simply given the strong will exit this storm stronger, and I think Apple is one of those strongest companies. Keep in mind, Apple trades at a discount to the other tech companies because of its combination of hardware, services, and wearables. That hardware piece, which the company has long been penalized for, I think will exiting this will actually be an asset to it and be positive. So putting this together, I know this is going to seem like I'm out of touch with reality, but I still think Apple, once we revert to some sort of normality, is a $400 plus stock.
All right. Well, let's see when normality might come. Although, Dan, for as much as the stock has come in, we're only back to prices that it never had reached before until mid-December, right? That's how fast the rise was before we did top out. So does Apple seem like a decent risk reward here, or how would you handle it?
Well, I agree with Gene, Mike, in terms of the growth going forward. I mean, we've got this little bit of a lull related to this virus, but if you think about everything that we're banking on with Apple going forward is still intact. I mean, we're still looking for the holiday quarter for the 5G rollout. We've got a $400 phone that we haven't heard anything about, but it's supposed to come out in March. As Gene was saying about the services and kind of the changing dynamics of their revenue stream, I think going forward, we're still very positive on Apple. We have a very large position in the stock. We started buying it back in July of 2005 at a cost basis of about $5.20 a share. So it's made a big run for us. So I would think, as Gene was saying, I think you look at this as an opportunity to, find the stock here at about 21 times projected earnings. You're looking at about 14% growth in profits for fiscal year 2020. So I think it definitely creates an opportunity going forward. And I would agree with Gene. I think people who can look at the stock and think 3 to 5 years out, you should do very well.
This is a question for either of you. This is Liz Young. Apple was one of the first companies, if not the first company, to come out and issue guidance that they weren't going to hit revenue targets because of the virus. Does that bode well? Does that conservative stance bode well for them leading us out of this if we have a rally?
I think what that guidance, what it really speaks to, is more just a company that has wants to communicate well. It does not bode well in the near term. Their business has the impact on the demand side, which has been well articulated, 17% coming from China. They obviously have the supply side that's impacted by China. But I think that really misses the point. I think what you have here is a high caliber company. And I think the way that they've led, I think, in the communication on this is something that seems really subtle and maybe obscure, but is really important in terms of the quality of the team. And ultimately, I think the market is going to look to Apple as kind of a barometer going forward of when things normalize.
Dan, if we broaden it out a little bit to other parts of tech, if you look at semiconductors, yeah, sure, they're down, but really not much more than the overall market. Does that seem like it reflects just an underlying positive trend in that area, or do you see more room for those to come in as we reckon with the implications of the Asian supply chain and everything else?
Well, Mike, as you guys have talked about, I mean, the semis are kind of in the line of fire, right? You've got issues with production because a lot of their production facilities are in that part of the world. a lot of the companies like Qualcomm and Texas Instruments derive a very large percentage of their profits from China. So I think the semiconductor sector has been a little bit ahead of itself. We've actually surpassed the previous peak that we hit in the summer of 2018 when we dropped off on the tariffs, and everybody was waiting for this turnaround that's now been pushed out to 2020. So that's still going to be a little bit of a tough group, because if you look at the core fundamentals, yeah, we can talk about 5G and wireless going forward. We could talk about all these things that should happen that are positive, but you're still looking at, DRAM pricing that's weak. You're still looking at autos that's very difficult. There's different things that still haven't turned around fundamentally. So I still think we have a little bit more to go in terms of chips. We might have to wring it out a little bit more before we can say, okay, we've hit that low. We're ready to go. The fundamentals are in place. So I still think we have a little bit more time, Mike, on the chips going forward.